In this video, I want to explain why Treasury bills could be, a poor choice for investors who are targeting aggressive growth or they want to make a higher level of returns. And so these are the disadvantages of Treasury bills. Number one is low yield due to their low risk. The typical yields for treasury bills are generally very low compared to corporate bonds, compared to stocks, making them less attractive for investors who are looking for high yield, who are looking for greater returns, who are looking for a kind of returns that would really keep them comfortable, keep them motivated when it comes to investing. Number two is inflation risk. The fixed return treasury bills offers, unfortunately, may not outpace inflation. If the rate of inflation is very, very high, you discover that the interest rate coming in may not be able to beat inflation. Let's say the interest rate coming in is, let's say, 10%, and the inflation in the economy is 11 or 12%. You discover that the interest coming in will have a lower purchasing power, may not be able to outpace inflation. That's a typical disadvantage we should not forget to consider when it comes to investment in treasury bills. And so number three is there's no regular interest payments. No regular interest payments. So treasury bills do not pay periodic periodic coupon like what you could get in government bonds and corporate bonds, because the investor earned a return when the bill matures, which may be less desirable for those seeking regular income. When it comes to treasury bill, because of the short duration involved, the returns coming in is not like what you could get from a typical government bonds, because these bills are like discounted right from day one. They are discounted, and the return you get is at the end when when the government gives you back your capital. So the money they give you, minus what you paid, is called the yield. So the purchase price and the face value of the stock, when you subtract the difference gives you the yield. And so you don't really have regular, income like what is obtainable in a typical bond. Number four is taxable at the federal level. The federal government will certainly tax the income at maturity. Whenever you want to sell, or whenever the government wants to pay you back your money, the government will tax that yield. Let's say you bought it at maybe let's say 800 naira, you are selling at 1,000 naira. That's a 200 naira difference. That 200 naira yield, the federal government will tax it. So you may not end up with 200, you may end up with less than 200 naira. So if the tax rate on that 200 naira is 10%, you end up with 180 naira instead of 200 naira. So the government is always there to tax these instruments. Number five is opportunity cost. When you choose to invest in treasury bills, that opportunity cost is always there. You have other investments you could have invested in. All right, so you have to consider the opportunity cost. If you're to invest in in stocks, if you're to invest in real estate or in corporate bonds, this instrument may yield a higher returns compared to what is obtainable with the treasury, obtainable with a typical treasury bill investment. So always consider the opportunity cost when it comes to investments generally. Then number six is the reinvestment risk. When treasury bills matures, investment face the risk of reinvesting their funds at lower interest rates. especially in a declining, in a declining rate environment. Let's say you sold your investment and you made a certain amount of profit and you want to buy again. You discover that you may not make that level of profit again. So there's that reinvestment risk. Let's say initially you bought at 800 naira, you know, the government pays you 1,000 naira maturity. Next time, you may end up buying at 900 naira, and the government will still pay you 1,000 naira if you choose to reinvest. So you reinvest at a lower return. That's what is called reinvestment risk. Please like this video and subscribe to this channel. It would really keep me motivated, actually. Number 7 is short-term focus. It's a short-term instrument, actually, in the sense that the duration is just less than 1 year, less than a year. The returns are typically lower than long-term bonds or equity investments. It's short-term with a lower return compared to long-term, long-duration bonds and investment in equities. Number 8 is interest rate sensitivity. Treasury bills are less sensitive to interest rate changes than longer-term bonds. So longer maturity treasury bills can then still be affected by rising interest rates, which could reduce their price, in the secondary market. It's still sensitive to it's less, compared to compared to government bonds, that interest rate sensitivity is relatively low, because it's short-term instruments, then it's not as affected by interest rates compared to a longer term instrument like government bond that that has a duration of 20, 30, 40 years, as the case may be. Number 9 is limited diversification. While treasury bills provide safety and liquidity, they may not provide sufficient diversification, or growth potential for investors looking to build a more balanced portfolio, across different asset classes. It has that limited diversification potentials because it's just a short-term instrument. You are a long-term investor. You want to invest you want your investment to run for the next 10, 20, maybe even 25 or 30 years, and you are investing in something that has a duration of only a year. So it will not give you the kind of diversification you would love to have. So in this case, it's quite limited. Number 10 is not suitable for high yield seekers. You're looking for high yield, please look elsewhere. You cannot obtain high yield in this in this instrument because first of all, it's a shorter duration kind of investment, and so they don't offer. It's not risky, so you don't really get as much as what you could get in stocks and a longer duration bond. These disadvantages make treasury bills less appealing for investors seeking higher returns or income generating investment. You don't generate regular income because it's a short period of time, so the income comes in only once. But if it's a long duration bond, it comes in biannually for as long as it takes the bond to mature. But they may remain attractive option for those prioritizing safety over liquidity. People who have maybe probably made it, and they just want to conserve their money. Then this particular investment is for them. But for the young investor, you can try it, but you can try for the experience. Actually, it will really help, but not for the yield because it's not really much.